Welcome back to our channel, and today we will be looking at Understanding Nigeria's Economic Indicators, a comparative case study with South Africa and India. Nigeria, South Africa, and India share common ground in their economic histories. They have all grappled with colonial legacies, structural economic challenges, and the quest for sustained growth. However, each has taken unique paths in navigating these issues. This article examines Nigeria's economic indicators, using South Africa and India as benchmarks. By comparing these countries, we gain insights into the opportunities and challenges that Nigeria faces. 1. Gross Domestic Product, GDP, and economic growth. Nigeria is often referred to as the giant of Africa due to its large population and significant natural resources, especially oil. As of recent data, Nigeria's GDP stands at approximately $440 billion, making it the largest economy in Africa. However, its GDP growth rate has been inconsistent, heavily influenced by the global oil market. The country has experienced significant fluctuations due to its reliance on crude oil exports, which account for more than 90% of its foreign exchange earnings. South Africa has a more diversified economy compared to Nigeria, with key sectors including mining, manufacturing, services, and agriculture. With a GDP of around $350 billion, South Africa's economy is the second largest in Africa. However, the country has faced challenges such as slow growth, high unemployment, and inequality. Despite these issues, South Africa's economic policies have aimed to stimulate growth through infrastructure development and investment in human capital. India presents a fascinating case with its rapid economic growth and large GDP of over $3 trillion. It is one of the world's fastest-growing major economies, driven by a mix of services, manufacturing, and agriculture. India's growth is primarily fueled by its large consumer market, technological advancements, and a young workforce. The country's focus on information technology, pharmaceuticals, and a growing middle class has contributed to its robust economic expansion. Comparison: while Nigeria has the largest GDP in Africa, its growth is heavily oil-dependent, making it vulnerable to external shocks. South Africa's more diversified economy offers some resilience, but faces internal structural challenges. In contrast, India's diverse economic base and technological advancement provide a model for sustainable growth. For Nigeria, lessons can be learned from India's diversification and South Africa's structural economic reforms. 2. Inflation and monetary policy. Nigeria has struggled with high inflation rates, often exceeding double digits. The country's inflation is driven by several factors, including fluctuating food prices, currency devaluation, and import dependency. Nigeria's central bank has employed various monetary policies, such as adjusting interest rates and managing foreign exchange reserves, to control inflation. However, these measures have had mixed success, often leading to a challenging environment for businesses and consumers. South Africa has generally maintained lower and more stable inflation rates compared to Nigeria. The South African Reserve Bank has a clear inflation targeting policy, aiming to keep inflation within a 3 to 6% range. This stability has been achieved through prudent monetary policy and a relatively stable exchange rate. However, South Africa faces challenges such as economic inequality and pressure on consumer prices, particularly in the energy and utility sectors. India has also faced its share of inflationary pressures, primarily due to its large and diverse economy. The Reserve Bank of India, RBI, has implemented inflation targeting as a monetary policy framework, aiming to keep inflation within a 4% range, with a tolerance band of plus 2%. The RBI uses tools like interest rate adjustments and open market operations to manage inflation. Despite some volatility, India's inflation rates have generally been more controlled compared to Nigeria. Comparison: Nigeria's struggle with high inflation contrasts with the more controlled environments of South Africa and India. The differences highlight the importance of effective monetary policy and economic diversification. For Nigeria, adopting more effective inflation-targeting measures and reducing import dependency could help stabilize prices and enhance economic growth. 3. Unemployment and labor market dynamics. Nigeria faces significant unemployment and underemployment challenges, with rates exceeding 30%. The country's high population growth, coupled with inadequate job creation, has led to a large youth unemployment crisis. The informal sector absorbs a significant portion of the labor force, but these jobs often lack stability and adequate compensation. Structural issues such as inadequate infrastructure, education, and training further exacerbate the unemployment problem. South Africa also grapples with high unemployment rates, hovering around 30%, similar to Nigeria. The country faces structural unemployment due to skills mismatches, rigid labor laws, and a slow-growing economy. The youth unemployment rate is particularly high, reflecting a need for reforms in education and vocational training. Despite having a more developed formal sector than Nigeria, South Africa's labor market struggles with inequality and limited job creation. India's unemployment rate is lower than Nigeria's and South Africa's, but it faces challenges with underemployment and a large informal sector. The country has a vast and diverse labor market, with a significant portion of the population engaged in agriculture and low-skilled jobs. India has made efforts to create employment through initiatives like Make in India and Digital India, aiming to boost manufacturing and technology sectors. However, there is still a need for more quality job creation to match the demands of a growing population. Comparison: both Nigeria and South Africa face high unemployment rates, though their challenges stem from different sources. Nigeria's unemployment is driven by a lack of diversification and structural inefficiencies, while South Africa's is influenced by labor market rigidity and economic inequality. India's experience shows the importance of government-led initiatives to boost job creation and the value of a diversified economic base. For Nigeria, focusing on education, skills development, and creating an enabling environment for businesses could be key to reducing unemployment. 4. Trade balance and export diversification. Nigeria's trade balance is heavily skewed towards crude oil exports, which account for the majority of its foreign exchange earnings. This reliance on a single commodity makes Nigeria vulnerable to global oil price fluctuations. Despite efforts to diversify its export base, non-oil exports remain relatively low. Nigeria's import bill is also high, driven by the need for machinery, chemicals, and food products, leading to a trade deficit during periods of low oil prices. South Africa has a more diversified trade portfolio, exporting minerals, vehicles, machinery, and agricultural products. The country has managed to maintain a relatively balanced trade account, though it occasionally experiences deficits due to imports of oil and consumer goods. South Africa's diversified exports provide some insulation against global commodity price swings, but the economy is still exposed to global demand fluctuations. India has a diverse export base, including services, pharmaceuticals, textiles, and IT products. The country's trade balance has been traditionally in deficit due to high imports of oil and gold. However, India's robust export of services, particularly in IT and software, has helped mitigate the trade deficit. The Make in India initiative aims to boost manufacturing and reduce import dependency, contributing to a more favorable trade balance in the long-term comparison. Nigeria's heavy reliance on oil exports contrasts with the more diversified trade profiles of South Africa and India. This reliance exposes Nigeria to significant risks from global oil price volatility. Diversifying exports and developing other sectors like agriculture, manufacturing, and technology could help Nigeria achieve a more stable trade balance. Learning from India's focus on services and South Africa's mix of exports can guide Nigeria in developing a more resilient trade strategy. 5. Foreign direct investment, FDI, and business environment. Nigeria has been an attractive destination for FDI due to its large market size and natural resources. However, investment flows have been inconsistent due to factors such as political instability, regulatory challenges, and infrastructural deficits. Sectors like oil and gas, telecommunications, and manufacturing have received the most FDI. The Nigerian government has made efforts to improve the business environment, but issues like corruption, bureaucratic red tape, and security concerns continue to hinder FDI. South Africa has a more developed and sophisticated financial market, attracting FDI in sectors such as mining, manufacturing, finance, and real estate. The country offers a relatively stable business environment, though recent challenges such as policy uncertainty, energy supply issues, and labor strikes have affected investor confidence. Despite these challenges, South Africa remains a key investment destination in Africa due to its infrastructure, market access, and economic diversification. India has seen a surge in FDI in recent years, driven by economic reforms, a large consumer market, and a focus on sectors like technology, manufacturing, and services. The Indian government has implemented policies to ease foreign investment, such as reducing regulatory hurdles and offering incentives for sectors like manufacturing and IT. India's business environment has improved, reflected in its rising rankings in global ease of doing business indices. Comparison. While Nigeria has potential for attracting significant FDI, it faces challenges in creating a conducive business environment. South Africa's more developed infrastructure and financial markets give it an edge, but internal challenges impact investor confidence. India's proactive reforms and focus on easing business operations have made it a preferred destination for FDI. Nigeria can learn from India's regulatory improvements and South Africa's market sophistication to enhance its appeal to foreign investors. 6. Poverty and income inequality. Nigeria. Despite being Africa's largest economy, Nigeria faces significant poverty and income inequality. A large proportion of the population lives below the poverty line, with limited access to basic services like healthcare, education, and clean water. The wealth generated from the oil sector has not translated into broad-based economic development, leading to regional disparities and social unrest in certain areas. South Africa also struggles with high levels of income inequality, a legacy of apartheid policies. While the country has made progress in reducing poverty, a significant portion of the population still experiences economic hardship. South Africa has implemented social programs and policies to address inequality, but structural issues like unemployment and unequal access to quality education and healthcare persist. India has made significant strides in reducing poverty, with millions lifted out of extreme poverty in recent decades. However, income inequality remains a challenge, with disparities between urban and rural areas and across different states. India's economic growth has been uneven, and efforts are ongoing to ensure more inclusive growth through policies aimed at education, healthcare, and social welfare. Comparison. All three countries face challenges related to poverty and income inequality, though the contexts differ. Nigeria's wealth concentration in the oil sector and lack of infrastructure contribute to high poverty levels. South Africa's historical inequalities and India's regional disparities pose unique challenges. Policies focusing on inclusive growth, social welfare, and equitable access to opportunities are crucial for addressing these issues across all three nations. 7. Infrastructure and development indicators. Nigeria's infrastructure development lags behind its economic potential. The country faces challenges in power supply, transportation, and healthcare infrastructure. which hamper economic growth and quality of life. Efforts are being made to improve infrastructure through public-private partnerships and foreign investment, but progress has been slow due to funding constraints and governance issues. South Africa has relatively well-developed infrastructure compared to other African nations, with established road networks, ports, and communication systems. However, the country faces challenges in maintaining and expanding this infrastructure, particularly in energy supply and public transport. Infrastructure development is crucial for South Africa to sustain economic growth and improve living standards. India has made significant investments in infrastructure development, particularly in urban areas, transport, and communication networks. The government's focus on initiatives like smart cities, renewable energy, and expanding road and rail networks aims to address infrastructure gaps. Despite progress, India still faces challenges in rural infrastructure and ensuring access to basic services for its vast population. Comparison: Nigeria's infrastructure challenges are more pronounced compared to South Africa and India. Improving infrastructure is key to enhancing Nigeria's economic growth and competitiveness. South Africa and India offer models of how targeted investments in infrastructure can contribute to overall development. For Nigeria, adopting similar strategies and focusing on energy, transport, and healthcare infrastructure can drive sustainable growth. In summary, understanding Nigeria's economic indicators in the context of South Africa and India provides valuable insights into the country's potential and challenges. While Nigeria has the advantage of vast natural resources and a large market, it faces hurdles in areas such as economic diversification, inflation control, unemployment, and infrastructure development. South Africa and India, though facing their own unique challenges, offer lessons in economic diversification, monetary policy, and infrastructure investment. By learning from these countries, Nigeria can adopt strategies to foster sustainable growth, reduce poverty, and enhance its position in the global economy. Ultimately, the journey toward economic development requires a multifaceted approach, addressing structural issues, enhancing human capital, and creating an enabling environment for business and investment. By leveraging its strengths and learning from others, Nigeria can navigate its path toward a more prosperous and inclusive future.